Good afternoon, everybody, and thank you for tuning in. I truly hope that you are well and keeping warm in this chilly weather. Take your cup, a warm cup if you can, add a duvet if you're able to, and we hope you'll enjoy this plate of knowledge that we are about to serve you today. My name is Mina Maina. I work with Springboard Capital, and I'm in charge of customer experience. At Springboard Capital Limited, not only do we provide our customers with capital to grow businesses, we support their investments by providing advisory services to ensure that our clients' success now and in the long term is good. Springboard Capital hosts monthly BizSmart webinars, like the one we are holding today, every last Friday of the month. So I hope you can diarize that so that you never miss any of our webinars. These are geared towards sharing knowledge with all business owners, upcoming, those who have grown in the business, those who want to start. Everyone is welcome. In a constantly evolving environment, business owners who commit to learning new skills will be better able to adapt to change and keep their businesses going in challenging conditions. Our interactive sessions are designed both for new and established business owners. In all cases, the objective is to build the business owner's capacity to successfully run and grow their businesses. Today, I am honored to host you in this exciting session that we dubbed Develop Your 2023 Investment Strategy Now. Why now? In Swahili, we say, kama sio sasa, ni sasa hivi. And the new term in town is mapema ndio best. Managing finances, both in business and at a personal level, is not immune to complexities. From dealing with acquisition to management to monitoring of finances, it requires adept financial management strategy. What simple hacks can be put in place to ensure success, even during times of turbulence that require resilience? What wealth management skills are required to ensure personal and business success? What tips can be put in place to develop an investment portfolio that meets your return expectations? We always ask, what can be done now with regards to financial management so that it outlives your legacy aspirations? Join us today as our wealth management expert expounds on these key strategies for investment, for financial management, for portfolio diversification, and learning how to select the right financial advisors. At this juncture, it is my absolute pleasure to introduce to you our speaker of the day, Mr. Timothy Mwendia. He's an entrepreneur turned investment analyst who derives pleasure from not only saving, but also combing through investment options, looking for the one with highest returns. Timothy believes that developing an investment mind can enable you achieve financial independence in your lifetime, and much more before your sunset years. Even more important is the ability to defer immediate gratification for future glory. For you to take calculated risks when you spot an opportunity, and the ability to develop a thick skin as you journey the long, hard road towards financial success. In addition to being an investment analyst, he's also involved in agriculture, where he has a passion in feedlot farming, as well as cultivating tomatoes and has avocados. Timothy boasts over 20 years of experience at the Nairobi Stock Exchange, trading both equities and bonds. He has a Bachelor of Commerce in Finance from the University of Nairobi and is also a CPA finalist. Timothy's vision is to see a financial literate world where everyone works towards attaining financial independence. What a privilege it is to have you talk to us, Mr. Timothy Mwendia. Over to you. Karibu sana.
Great. Good afternoon, everyone. It's a pleasure to host this month's session, and it's quite really humbling. And thank you, Mine, for that wonderful intro. I really wouldn't add more to that. And I think because of time, I think I was just given 30 minutes, which includes the Q&A. So I just want to quickly delve into the meat. And then now where I'm looking forward to is basically the Q&A session. So we will journey together, and I hope that all of us will be able to learn and not just learn, but put into action what we have learned today, or what we will learn today as the year begins in just under 2 months. So great. The topic that I was given is develop your 2023 investment strategy now. A sneak peek into the Wealth Management Masterclass. That's very interesting because I can see words like investment and strategy, and I think it will be good to try and understand what is this thing called strategy. So, under the Oxford Dictionary, a strategy is defined as a plan of action designed to achieve a long-term or overall aim. So basically, a strategy is a plan, of action. And then what is an investment? According to the Oxford Dictionary again, an investment is the action or process of investing money for profit. So we have a strategy as a plan, and then an investment as an action. So it's a doing word. You're basically moving from just planning to acting. So then, what is an investment strategy? Having known what an investment and a strategy is. So we can say an investment strategy, therefore, refers to a set of principles designed to help an individual investor achieve their financial and investment goals. So this plan is what guides an investor's decision based on goals, your risk appetite, which is the risk tolerance, and your future needs of capital. So this is basically a set of principles designed to help you achieve your financial and investment goals. Great. So this investment strategy, for it to succeed, one has to be very careful that you write it down, because if you don't write it down, you will forget. People forget so much. And then, so the first thing is to have that investment strategy written down, write it down on paper. And then two, it has to be measurable. So you have to keep measuring this strategy with time to see how far you're going and whether you are really keeping tabs. Then it has to be repeatable. So it's something that you have to do it over and over again. And for this investment strategy, for it to succeed, it has to be based on beliefs about the markets, which could also be your competitive advantage. So one of the beliefs could be that if it's in the stock market, if the market goes down, then it is the right time to buy. So that should be one of your beliefs. So if that's your belief, then every time the stock market goes down, you buy. And every time it goes up, you sell. So that could be one of the beliefs. You could have another belief, which then with time ends up becoming your competitive advantage. So once you have that strategy written down in place, then it's only a matter of time before you can achieve your financial objectives. Now, let's move forward to what is financial management. We have talked about investments. We have talked about a strategy. So what about what is financial management? This financial management is basically broader than an investment strategy. Investment strategy falls under financial management. So financial management, here we are talking about planning, directing, monitoring, organizing, and controlling of money to accomplish business objectives and return maximum value to stakeholders. So in a company or business setup, this basically is handled by either a finance manager or a finance director. So, and then investments are handled by, you could have an investment manager or also an investment director. So one thing to note is that financial management is broader. So what are the simple hacks that can be put in place to ensure success, even during times of turbulence that require resilience? So times of turbulence require resilience, and hence the financial management strategy here would require you to take a defensive, or what we call financial or investment strategy, that would put more emphasis on investments that offer a high dividend yield as opposed to growth stocks. What do I mean here? If I can give an example of the stock market. In the stock market here in Kenya, we have the Nairobi Stock Exchange, or what we call the Nairobi Securities Exchange now. We have stocks or companies that traditionally pay high dividends, like Standard Chartered Bank or ABSA, previously known as Barclays, but the share price doesn't really change much. So you don't get a lot of capital gains. And here, when I talk about capital gains, I'm talking about the difference in price, the current price versus the price that you bought the stock at. So a stock like Standard Chartered Bank has traditionally been trading at around 140 shillings over the years. But every year it pays you about 20 shillings dividends. So you don't make much from appreciation of the share price, because it's really stays within a certain range, but you get lots of dividends from that stock. On the other hand, there are stocks that keep going up, like Safaricom, for instance. In just 2011 October, it was trading at 2 shillings and 50 cents. And last year, May 2021, it had gone up to 45 shillings. So that's about 20 times the value. But if you look at the dividends, it doesn't pay high dividends vis-a-vis the price compared to a stock like Standard Chartered. So when times are tough, like if the economy is not growing as much as it should, like right now where we are, where we have a problem with our currency, which has depreciated from 100 to 122, and we have high interest rates and a high inflation rate. So you find that the stock market doesn't perform very well in terms of turbulence. So what keeps an investor going in those times is you have to look for stocks like Standard Chartered that don't appreciate in price. They sort of like are stagnant in price, but when it comes to dividends, you're earning almost 20 shillings every year. So if you look at 20 shillings over 140 shillings, that's a very good return, more than 10%, almost 15%. So and that keeps you going. So when things improve later on and the economy starts performing, one now can then change your strategy from defensive stocks, which are also called dividend stocks, to now growth stocks like Safaricom, like Equity Bank, and those kind of companies. So that's one of the what we call a simple hack that you can put in place, putting your money in dividend stocks. So this way, the dividends paid would keep the business going during the tough times. Another thing you can do is cost containment measures, which you have to put in place. For example, the cost to income ratio must come down to reflect the tough times. So what is cost to income ratio? Cost to income ratio means basically the cost. So if it is a business setup, what are your costs every year? Or if you're producing an item like bread, for instance, which like the 400-gram bread, which goes for 65 shillings. What is your cost to produce that one loaf of bread? So assuming it is 20 and you're selling it at 60, then that is a good cost to income ratio, because now you're talking about 20 over 60. So the lower the cost to income ratio, then the better during tough times. So this could also be achieved by pegging most of the cost centers to revenue, such that costs should only increase if there is a corresponding increase in revenue. Costs with no contribution to revenue should either be descaled, reduced, or eliminated completely where possible. So if you're a company that's just starting out, an entrepreneur, what we call a startup company, try to, if it's you look for, try and make your expenses mostly dependent on the revenue. When it comes to salaries, you can choose to pay employees on commissions, which are based on the revenues that they bring, so that you just limit the costs that which we call like sunk costs that you cannot really change, which you have to pay, like rent, whether or not you have made money. Those kind of costs should be very, very, very limited. That way, then you can be able to survive in times of turbulence. They require lots of resistance. The other thing we need to look at are the skills, which we call the wealth management skills that you need to have, or that are required to ensure personal and business success. So businesses and individuals need to have the hard and soft skills. So you need to have both hard and soft skills to generate above average returns. So what are these hard skills I'm talking about? Now, hard skills, these ones are taught in school, or you can learn over time. So they are things like technical skills. In the stock market, we talk about things like RSI charts. You look at the charts because technical skills are based on the belief that history repeats itself. So whatever happened yesterday will happen tomorrow. So if you believe that at a particular point in time, the stocks normally go down and at particular times they go up, so then you base your decisions based on that. Like right now, we are in November, we are approaching December. So in the stock market, it's traditionally a slow period because everyone is just thinking about Christmas and going on holiday. So historically, the stock prices are normally low in November and December and the first week of January, because then people are thinking about the holidays and also the expenses that come in January, like paying school fees and buying textbooks and books for your kids and uniform. So at this point in time, a technician, who is someone who basically applies technical skills, will be in the market trying to scout for bargains, low stock prices between now and Christmas or the first week of January, get in, and then by March and April, they will be selling at a higher price. So those are skills that someone needs to learn. And also there are other skills which I'm calling the fundamental skills or fundamental analysis, which now looks at the profitability of a company. So it is more futuristic. So you look at ratios, which are like the profitability ratios, or you look at the gross margin, or you look at something we call the earnings per share, or another thing we call the price earnings ratio. So these are basically ratios. So price earnings ratio is like is an equivalent to the payback period. So you and the price earnings ratio is basically, the price is the stock price, the current price of a share, and then what is called the earnings is basically derived from EPS, earnings per share. So to make it easier to understand, if you invest 100,000 in a business, you ask yourself, how much will it give you every year? So if it's going to give you 20,000 every year, so the price is the 20,000. That's like the profit. And then, the price is what you pay. So what you invested is 100,000. And then what you're getting every year, what we call like now the earnings, is 20,000. So P over E. So 100,000 over 20,000 is 5. So what that tells you is that that business will take you 5 years to break even, for you to be able to earn enough to actually meet what you had put in initially. So if you have a business that has a payback period or a PE ratio of less than 10, which means that business is profitable. So later on, as we go on with the discussion, then we will look at the PE ratios, whether where we can get in, and when it goes up, then at what point do you can you sell to actually make gains? Because the end result here is you're looking to get above average returns, and remember this, you're supposed to repeat that over and over the years for this strategy to be successful. Yeah, so I've just talked about the fundamental analysis, and those are things I've been talking about: the payback period, the PE. And so we are saying the lower the readings, the more desirable to buyers. So a reading of like 5, like what we have just seen for that example I gave you, that is actually a good investment, because it pays back itself in 5 years. If it can be 3 or 2, even the better, because you're looking at getting higher returns that can cover your initial investment soonest possible. Now, soft skills, on the other hand, have to do with the psychology, human behavioral, and are mostly to do with greed and fear. Now, these ones you can't be taught in school. You acquire over time. And these are the most important. It's good to have the fundamental analysis and the technical analysis. Those are very good. They are taught in schools and you can learn over time. But the soft skills, now, those ones are very difficult to manage and to acquire. So you need years of experience to be able to develop these skills. For instance, when the stock market goes down, like it did during the corona period of March 2020, there was almost a collapse in the stock market. The prices were really going down by 10% every day. So the investors who are not very experienced were actually selling out of fear. Yeah, and so actually you should be doing the contrary. Instead of selling out of fear, you should actually be buying, and then when the stock market goes up, you should actually be selling and not buying. So what makes people sell when the stock market goes down is fear, and what makes people buy instead of selling when the stock market goes up is actually greed. So if you can manage fear and greed, then you can make lots of money in the stock market and generally any other business. Like I said, right now, the economy is not doing very well. We have just come from elections this year in August. And, we've had a dry spell. The rains have just started. And so inflation rates are high. And, when times are challenging, then it's the best time to make an investment. Be it in land, be it, there are people who are selling things at throwaway prices. Now, instead of you fearing and selling, you should actually be scouting for investments. So if it is that good business that's being sold at a throwaway price, if it's that wonderful piece of land next to the tarmac, and someone is selling because they are cash strapped, you should be buying it, because when things start opening up from January, February, when people start harvesting, and when the rains take effect, and then the inflation rate starts coming down and the shilling starts stabilizing versus the dollar, then the prices of properties and the prices of stocks, every asset, the prices will start going up. Why? Because people will have money in their pockets and they will be willing to pay more. People will have paid their school fees in January. In February, people will have recovered in late February and March. And so banks will be announcing their full year results for 2022. Dividends will be announced. So so that will be the time to sell. The time to buy is right now. Yeah. So younger investors, on the other hand, generally tend to have a higher. Let's move to another subtopic, which is the tips that can be put in place to develop an investment portfolio to meet your return expectations. We have to know that investors are very different. Why are they different? Because you have a young investor who is who wants to take risks. Yeah, so he's pro-risk, so he has a high risk appetite. And then we have the older investors who we say are risk averse, so they have a low appetite for risk. So since those investors are different, An investment portfolio would have to meet an investor's risk appetite and return expectations. Generally, we say in finance, the higher the risk, the higher the returns. All the investors are normally risk averse, and as such, the investment portfolios will comprise investments with a lower risks. E.g., the treasury bills and bonds, those ones, we actually call them risk-free securities. They actually don't carry any risk. The government will not default. When it's come to paying back your investment, they will actually just do another offer for treasury bills or bonds to pay the ones that are maturing. So those ones, we call them risk-free. And for older investors, they prefer such. But you also have to know that the returns are also lower than for the equity. So younger investors, on the other hand, would generally have a high appetite for risks, and as such, the investment portfolios will be composed mostly of risky assets like stocks. Yeah, so that's something one needs to know. Having talked about that, let's jump into this topic of financial management, which we want to outlive our legacy aspiration. So how can you actively financially manage your portfolio, your investments, your business in a way that it will outlive you and it will leave a legacy for the future generations? So for an investment portfolio to outlast you and leave a legacy behind, there has to be an investment strategy that follows the 4 rules which we highlighted a bit earlier. So lasting investment strategies have to be written, they have to be measurable, they have to be repeatable over and over the years. You have to do the same thing, because once an investment strategy has been tried and tested and proved to be working, then you need to keep doing the same thing, because again, we say that the long term is a summation of the short term. So every year, if you are able to make 20-30% over and over every year, so that cumulatively, we are talking about the compounding effect, then your portfolio will increase by leaps and bounds over the years, and you'll be able to leave an investment portfolio that will outlast your legacy aspiration. So those are the 4 strategies that one needs to apply for you to succeed and leave behind a legacy for your future generations. So if we can look at the key strategies, this I believe is quite important now that we are going into the year 2023. The key strategies for investment, financial management, portfolio diversification, asset allocation, and learning how to select the right financial advisors. So what are the key strategies of investment that we can apply as we start the year? For us to be able to make some decent returns. One of them is investing in growth companies when the PE ratios fall below 10. You see, what happens is that at times when the economy is on a slowdown, like we have been in the later part of this year because of the drought and elections, then you find that most of the PE ratios fall below 10. So once that happens, then those stocks or those businesses become attractive for buyers. So your work is to scout for those investments that have a PE ratio of less than 10. You remember that example I gave of an investment where you have put 100,000 and every year it's giving you 20,000. So that is a PE ratio of 5, because 100,000 divided by 20,000 is 5. That's a very attractive PE. And then when it goes to above 20, then now you can consider selling that investment because it is no longer attractive. you can imagine if you have a PE of 20, that investment that you have put 100,000. For it to have a PE of 20, it means instead of making 20,000, it is now making what? It's now making about 5,000. 5,000 every year. So if you can get someone who can buy, then you would rather sell to him and look for another investment with a low PE. And then another approach you can use is to adopt a defensive strategy, targeting dividend stocks with a dividend yield of 10% and above. Remember the example I gave of Standard Chartered Bank, which has a price of 140 and it pays dividends of 20. So if you look at that, then you can see you're talking about 14% of this is dividend yield is about 10%. And then the beauty of that is that in future, when the stock market goes up, this stock will increase in price from 140 probably to 160. So you will get both capital gains and then in addition to the dividend that you have gotten of 20 shillings. Another thing you can do, the third one, is investing 10% of your disposable income in either growth stocks or dividend stocks, or you can have a mixture of both. So that's another strategy. So if you are in business, then you can say you're making about 100,000 a month as profits. Then you can take 10,000 and put it aside and invest it in depending on your risk appetite. Yeah, so if you are like high risks, then you can put it in equities. If you you're not someone who prefers risk, then you can put it in treasury bills or bonds, or even with the banks, fixed deposits. They offer fixed deposits for 3 months, 6 months, that kind of thing. Then how do you deal with the risk question? This is another strategy you can use. So for in the case of this strategy that one can apply, you can take your age. So assuming you're 40 years, you can say 40% of my portfolio, the amount that I want to invest, that's 10,000. I will put it, which is now 4,000. I will put it in treasury bills or bonds or a fixed deposit account. And then the remaining 6,000, I will put it in equities, which are risky and offer, they have room for growth. So as you keep aging, so when you get to 50 years, then your bonds will, bonds or fixed deposits, here we're talking about fixed income, investing in something that you already know the return. Like a fixed deposit, right now, most of the banks are giving 10%. So if you put 10,000 or, for instance, 100,000 for ease of calculations, and you're getting 10%, that means you're going to get 10,000 in a year. So as you grow older, then you will have more of your allocation towards fixed income, which here is bonds, bills, or fixed deposits. So for someone who's younger, in their 20s, if you're 20 years, then that means only 20% of your investable amount should be put in fixed income, which is either bonds, bills, or fixed income, fixed deposits, which are held with commercial banks. And then another strategy for an income investor, you can redeploy the dividend. So if you're investing in a stock like Standard Chartered that pays an annual dividend of 20 shillings. So when you get that 20 shillings, you can decide to, instead of spending that 20 shilling per share, you can decide to be redeploying it back, to investing it back, so that you can compound the interest rate, moves from 14% in future to something like 20%, because every time you get dividends, instead of spending the dividends, you actually invest them. So let's move on to financial management, which is actually broader. What are the key strategies you can have for financial management? One, you can invest any excess cash from operations. If you're a business, you have excess money, you have sold your goods and or the service, and then you have paid your expenses and you remain with like 10%, then that one can be put in fixed deposits, treasury bills, treasury bonds, or equities. So for a company or a business, you can encourage quick payment of your sales by offering discounts to cash buyers. So you can say if you're so this commodity, I'm selling it at 100 shillings. So if you want to pay in cash, if you pay in 1 week, within 1 week, then I'm going to give you 10%. So instead of you paying 100 shillings, you will pay me 90 shillings. So that way you are able to quickly improve your sales. And basically, when I talk about sales, I'm talking about cash. Yeah, because you want to have as much cash as possible, and so that you can either invest it for higher returns. And then another strategy you can use for financial management is differentiating between an asset and an expense when spending hard-earned money, with emphasis geared towards reducing expenses that don't lead to increase in revenue. Remember the example I said, trying to tag all expenses or most of the expenses to revenue. Yeah, like paying salaries on commissions, or leaving only expenses that cannot be tagged to revenue, like rent, and maybe one or two more. But most of the expenses have ideally need to be tagged to revenue. On the receivables, here we're talking about debtors. One needs to avoid bad debts, or they come as a result of bad customers. So once you reduce your debtors, then what you're going to do is that you will be having cash, as opposed to selling and then you've not been paid, and you have debtors, and yet you still have obligations to pay. So with regards to suppliers, you can use strategies that can delay payments legally. Yeah, so you can enter into contracts with suppliers for a 30, 60, 90-day payment window. Supermarkets are very good in this. They enter into contracts with suppliers, so they pay them in 30, 60, 90 days. That way they can control their cash flow. So when it comes to loans, also your businesses, you have taken loans from different MFIs and banks. It is also advisable to consolidate these loans with one financial institution, so that you can end up paying. That way you'll be able to get some soft provisions, like the tenor can be made longer, so that your monthly pay is reduced, as a way of managing your cash. And also you can also consider barter trade for those suppliers you need to pay, who can accept an item instead of you paying them cash. If you have those slow moving items, then you can offer them to the suppliers who would accept them instead of cash payment. So you tend to have more cash, which now you can deploy in these investments we are talking about that generate returns. Now, lastly, because of time, what are the key strategies for portfolio diversification and asset allocation? So what are the strategies here? You want to diversify a portfolio. So a portfolio is basically a mixture of assets, or a collection of assets, like a basket of assets. That's what we call a portfolio. So one, you target key sectors of our economy, so maximum 3, and determine the percentage of each, with a higher percentage going to the most profitable sectors of futuristic sectors. Like in Kenya, the most profitable sectors are telecommunications, where Safaricom is, banking, and then we have retail, where supermarkets falling. And then 2 is investing both risky assets, which we have termed as equities, and risk-free assets, which we are calling the bonds or the bills. And using your age, like the previous example I gave you, as at the risk-free percentage. So the older you get, you have more allocations towards the risk-free assets. And then the third one is investing a particular percentage in growth stocks and the rest in dividend stocks, with a view to increase your exposure to defensive stocks, stocks like Stanchart that pay high dividends as you age. Great. Lastly, how do you then get to select the right financial advisors? This is an interesting one. What we have learned with time is that big or large investment banks are preferred to small ones, as they tend to be more financially stable They can also afford to hire qualified financial investors with both the experience and the skill to offer sound investment advice. Small investment banks might not be as financially stable as the large ones and may also struggle to attract qualified and highly experienced investment advisors, but are generally very responsive to customer needs and are quite good at customer service. So another parameter an investor can use in determining which financial advisor to pick is the returns offered annually. What we have seen also is that small investment firms tend to offer higher yields than larger firms. So indeed, the principle of finance, which we say of the higher the risks, the higher the returns, holds true. Ladies and gentlemen, we have come to the end of that session. I will leave my contacts and my name with you there, so that in future, anyone who wants to consult me on any of the issues I have spoken or any other will be free to do that. So I think thank you so much for lending me your ears. At this point in time, I want to take you back to Mine. Thank you so much, everyone, for listening to me. Thank you.
Thank you so much, Mr. Mwendia, for that thought-provoking, knowledge-impacting presentation. And I am sure we have learned a lot. For the four of us who are rookies in investments, I know we have come out of this lunchtime break with something. And we have a question from Mr. Kenon Mbae. He says, thank you very much for the presentation. He'd like to know, are Forex trading and cryptocurrency safe investments?
About Forex trading, that's a new avenue that is gaining traction in Kenya. And I must say it's one worth looking about, and it's actually, as we speak, offering what we call the brokers in the stock market a run for their money, because most of the young investors, these people students in college, in their early 20s or late teens, they prefer the Forex market to the stock market. There have been very great improvements with the Forex market. In 2019, we got our first Forex broker, EGM Securities, that trades as EGM, that trades as FX Pesa. I have tried them and I am one of their customers. They offer very wonderful options for stocks that are not traded here in Kenya, like Twitter, like Microsoft. You've heard about the FANGs, which stands for Facebook, Amazon, Apple, Netflix, Google. Those are the stocks that people prefer there. And of course, the Twitter of Elon Musk. Those ones, you can buy them through Forex brokers like EGM Securities, like Pepperstone. And I think there is another one. We have like 3 or 4 Forex brokers in Kenya. And also you can trade, so other than buying those stocks, they are traded as CFDs, what is called contract for differences. And you can also buy oil. Oil right now has really gone up. You can also buy gold, silver. With them, you can also buy what we call the currencies, which is you can do Euro USD, you can do JP, that is JBP, Great Britain pound, and versus the dollar. And also you can do the what we call the indices. That's the US 30, the US 500. Those are the most common indices. And yes, they are very risky. I would have to say that they are very risky and one has to be very careful. If you're not a pro, you can actually end up losing all your money. Yeah, all your money to that. And we have had young guys who have lost everything in Forex. So one has to be very careful. You need to open a demo account and don't over leverage. Yeah, you have to learn fast on the demo, and it takes time, months, before you can plunge into the pool before you could take the plunge. But it's a wonderful thing. You can, it's another opportunity, but they carry lots of risk. Thank you.
Thank you. I hope Kenon has been satisfied. Anastasia asks, where would a rookie investor begin?
Wow. So, it depends on them. One has to know who they are first. Are you a risk-averse investor? Are you someone who wants to take risks? So, like I said, generally, younger people tend to go for risk. They love risks. Yeah, and anyway, their age allows them to. So, as you age, then you don't have much more opportunities to lose money or to take risks that are not calculated. So once you get to know who you are, what is your risk appetite is what I would ask you. If your risk appetite is low, then I would advise you to go for treasury bonds. We have right now the government is busy offering what we call infrastructure bonds that are not only risk-free, but are also tax-free. You don't pay taxes on infrastructure bonds, and they offer 14%. The stock market also is a good time to invest because it's low. Right now, the NSE 20, which stands for the Nairobi Stock Exchange, is at 1,680. That's very low. I have to say that in 2002, when Kibaki got into power, the stock market was where it is right now, slightly lower, of course. And then it went up to 6,000 because that president was very good with the economy. And then it has come down from 6,000 in 2013, it was at 5,000 to currently 1680, which is quite low. But like I said, that is a very good time to invest. Instead of selling, this is the time to invest. So for, I believe it's Anastasia, this is your time. You can begin by investing in those sectors I have told you, like telecommunications. Safaricom has just ventured into Ethiopia. So they are registering about 15,000 people every day, 15,000 new subscribers in Ethiopia every day, which means over the last 3 months, they have been able to sign up 1 million subscribers. So in a market of 100 million subscribers, by the end of in 3 years, they'll be able to actually have about 50 million subscribers, surpassing what they have in Kenya. So you look at that and say, yes, it's a good investment. Equity also is doing very well. They are in DRC with a market of about 110 million. And that country, very few people have bank accounts, so there's lots of opportunity. So for the rookie investor like Anastasia, you can put some little money in Safaricom, little money in equity. You can start there. Equity is in the banking sector, which is also very profitable. Safaricom is on the telecommunication sector, which is very profitable. They're making money from M-Pesa, they're making money from internet. Right now, they're doing very well in home fiber, and they're entrenching themselves in Ethiopia, which is a bigger market than Kenya. Thank you. Another question, please.
Thank you so much. Daniel Theory asks, what is your take in regard to investors seeking services of registered financial and investment advisors by investors, ISIFA professionals, etc.? What are the disadvantages of not seeking such advisory? And you can combine this with what is your comment on Kenyans falling prey of pyramid schemes, the get rich quick schemes every now and then? What are the lessons that we may need to learn from past cases, and how can we prevent such scenarios in future? Okay, great. If I start with the first question, I think it's good to seek professional advice from registered financial advisors. It is very important. If you are an amateur investor or a rookie investor, I think you need to seek advice. Most of the brokers, investment banks that are registered with the stock Nairobi Stock Exchange have qualified
employees who can actually give advice. You have the big investment banks in Kenya. We have Kestrel Capital. We have Standard Investment Bank. We have Dye & Blair. We have what are they called? There is FAIDA, and there is EGM. Sorry, EGM is for the Forex, and there is I think EF something there. But the big ones are basically Kestrel Capital, Dye & Blair, and FAIDA Investment Bank. But they also, like if you go to Barclays, they have their, ABSA, they have their financial advisors who can advise on either to whether if you want to go with equities, depending if your risk profile is high, then you can consult advisors on those risky investments. If your risk appetite is low, then of course they will guide you towards a balanced portfolio which has a mix of both fixed income securities like bonds, bills, and fixed deposits with commercial banks. There's also commercial papers, corporate bonds from solid companies like EABL. If your risk appetite is extremely low, then I would advise you for free to put your money in treasury bonds. You need to go to central bank and open an account. It's a CDS account with central bank, and you can be getting 14% every year, particularly for the infrastructure bonds, and they are tax-free. So the second question about falling prey to Ponzi schemes, the general rule is that when the deal is too good, think twice. I will tell you for free that anyone promising you returns of, I don't know, 5%, 10% a month, those ones are basically lying to you. We don't make those kind of returns. Once in a while you can do, but maybe once in 5 years you can do 10%. If you're lucky, you get into a stock and it announces results. And so the red flags are basically how they get people on board to swindle people is by offering high returns. You remember even Chase Bank, which collapsed, I think, in 2016, was offering very high returns. And it was a sad story. Many people lost their funds. Thank you.
Thank you so much. And Ken Joroge asks, what would be some of the signals that would tell you when to invest and when to pull out?
One of the signals that would help you know when to invest is when no one is talking about something. You know, right now in the stock market, no one is talking about the stock market, even in the streets. Yeah, people are not talking about the stock market. Yeah, that is a signal to buy. Yeah, why? Because people are fearful. That's why they're not talking about the stock market. If you go to an investment bank's offices, the one nearest to you, like in Westlands, you know, you will find that the halls are empty. People are not investing. Yeah, that's a signal to buy. What are the signals to sell? When everyone is talking about the stock market, yeah, when everyone says the way they have made 20%, 100%, I put 1 million now, almost 10 million, you know, everyone is happy. That is the time to sell. When you go to the stockbrokers and all their offices are full, people are queuing like was the case in 2006 during the regime of Mwai Kibaki, may his soul rest in peace. Many millionaires were made. I believe we are going to get back to that euphoria that was there 10 about 16 years ago in 2006. I am happy with the pick for Finance Minister Professor John Ndongo. He has what it takes. He was the one who was involved in the Kibaki era, where Safaricom started M-Pesa and Equity Bank grew to become the biggest bank that it is today in East and Central Africa. So this is the time to invest because the signals are there. No one is buying and the stockbrokers' offices are empty. This is the time to buy. You buy in silence. You buy at low prices. Another thing you look at, I forgot to say, is the PE ratio. What I talked about in the presentation. you look at the PE ratios, right now they are quite low. Yeah, they're quite low. Some even three. Like I was looking at KCB's PE ratio is about 5, which means you buy a stock at 37. In 5 years, you have recovered your investments, and now then you from there is just making profits. So PE ratio is something else to look at other than the empty stockbrokers' offices, and also the fact that people are not talking about stocks. This is the time to buy. Thank you.
Thank you very much, Mr. Timothy. And of course, we would want you to go on and on and on because we are learning so much today. Mr. Timothy shared his contact, but Timothy, where else can we find you? Social media handles? Any other contacts you can share with us?
Yes. You can reach me on the social media handle. I'm on Twitter at Mwendia Kabutha. Mwendia Kabutha at, you know, that thing for at, capital M and capital K, Mwendia Kabutha.
Awesome.
Yeah, you can drop me your questions on that handle, and I will be glad and happy to answer you back.
We are so happy to have you today and for all the good insights you have taught us. And to our audience, Springboard Capital is a microfinance company that has transformed lives by offering financial services to individuals and businesses for the past decade. Yes, we've been here for over 10 years. We offer loans that save you money, and we are focused on putting customer convenience at the center of our processes. We believe in building a relationship that goes beyond traditional financial lending and results in a more valuable and a mutual benefit partnership. Kindly share your name and contact on the WhatsApp link posted on the chat, and we shall engage you on our financial product offerings. You can find us at our 3 branches, Townhouse, or rather in town, we are at Kagen House, first floor, Thika at Sour House, first floor, and our head office is at CPS Center opposite Survey on Thika Road. We are on the 3rd floor. We are also on Instagram, Facebook, Twitter, and LinkedIn as Springboard Capital. You will also find us on our website, that is www.springboardcapital.co.ke. Thank you very much for tuning in, and see you next month on the last Friday. As always, thank you. Bye.